We've talked in this podcast before about how politics really shouldn't affect the stock market. Most of the time, it really doesn't, but it seems to of late. So, James Gauthier is going to join us after this word from our sponsor to talk about what is happening in the markets. James, great to see you again.
Okay, great to see you as well.
You know, we had the Trump rally at the beginning of the year, and the markets around the world have given back most of the advances, and in some cases have moved into bear market territory. So let's start with the global trade war that we're looking at, and then we'll get into the stock markets. This on again, off again, tariffs around the world. What are your thoughts?
Well, personally, I don't think I want to do business with Donald Trump. He's a tough negotiator. I mean, you know what? It's more bark than bite, I think. It's headlines every day. It's constantly changing. It's a lot of back and forth. It's hard to really understand what the end game is here. What is Trump really after? Um, and in the meantime, it's causing chaos, confusion, uncertainty, which is disrupting the markets. Uh, it's all going to pass, so I wouldn't get too worked up about it, but it is frustrating and distracting. And it's forcing us to have many conversations with clients just to keep them settled down and focused on what really matters.
Well, and to be fair, though, if you look at the stock market, as I said, some of them are in bear market territory, especially in the United States. Is that just the stock market responding to all the uncertainty, or is there something underlying as far as the economy and stock earnings or that kind of stuff?
Yeah, well, there are economic fears, and they could be justified.
Hmm.
But if we look at what's happened in the last 2 years prior to Trump's inauguration, markets had very, very good years. So it's quite possible that people are looking for an excuse to take profits, and this seems to be a reasonable one. But different markets are also responding differently to this. Europe and international markets are actually up during the same time when U.S. markets are down more than 10%. It's actually very close to 10% off all-time highs, we might add. Canadian markets aren't down quite as much as the US markets. So it really depends on your perspective. Bonds have actually done reasonably well throughout this time period, as there's probably going to be a bit of a safe haven effect there. Gold has also done well. So it's not like it's all doom and gloom. There are some bright spots.
Okay, so then do I need to worry about this for the next 4 years, or is it until the next U.S. congressional election, or could it go away tomorrow? I mean, how long could all this last?
Well, if you think about the motivation of politicians, they are always focused on retaining power. That is their number one objective. It's selfish, but that's how all politicians in all countries tend to operate. It's regaining power. And if we think about what the next date on the schedule is to consider, at least from the American point of view, you've got the midterm elections in November of 2026, which is only a year and a half away, a little over a year and a half away. And you can be assured that there is some political strategic thinking going on to say, let's get the bad stuff out of the way now, the unpopular stuff, anything that's going to negatively impact markets. What Trump wants to be able to say leading up to the elections in 2026 is the markets are at an all-time high. Look at what a great job I've done. That's what he wants. So he's getting the negative stuff out of the way now. And you can be sure he's going to be pumping up the stock market, whatever he can do in that direction towards November of next year. So I think it is going to be short-lived.
Okay, that's very interesting observation because I believe, as you probably do, that Trump watches what's happening in the stock market. Is that a fair kind of a comment?
Oh, of course he does. More
Yeah.
so than probably any other president in history.
Yeah. Okay. Talking about people watching things globally, the Bank of Canada has already moved on interest rates. What are your thoughts on interest rates right now, both in Canada and the future here in Canada, but also in the US or around the world?
Yeah, well, there are lots of things for central banks to consider right now. In Canada, the bank's central focus or primary focus, the only focus, is price stability. Central bankers in the United States have a dual mandate of full employment plus price stability. So they have different objectives, but in Canada, we've already seen interest rates on a declining path for a little over a year now. And that really comes off the spike that we've seen when inflation kicked in. Interest rates went as high as 5%. They're now down to under 3. So there's been a significant move down. The most recent change, I would say, is more of a continuation of reducing inflation fears. So that's not really politically motivated. I think they agreed to go another step this time around just because of the additional uncertainty that the trade wars could have on potentially reducing economic output in Canada.
Mm.
But the central bank was pretty clear in Canada in their last message that this is going to be the last move for a while unless something drastic happens, because they are just not too sure. There are still inflationary pressures that are above their target rate, but if there is economic problems, that could bring the pressure down quite quickly. So I think they want to wait and see how things are going to evolve a little bit before they commit to any types of increases or decreases in the future. The
Your point is
U.S.
well
is
made in Canada, but in the United States, as you point out, they have a dual mandate. Jobs is the other half of the equation. Do you think the same pressures are going on in the U.S.?
Well, the U.S. economy is much hotter than the Canadian economy right now. They're still worried about inflation there because it never really came down as much as it did in other places in the world. Their inflation concerns are still valid in the U.S., so they have not dropped rates like other Canada and other countries have done. So I think they're probably a little more focused on the job market, not the political uncertainty, not the economic uncertainty, because their economy is still doing quite well. But like I said, things can change in a hurry if there is some kind of recession or indications that there may be a recession. The U.S. central bank may rethink its policy, but they've been pretty stable and have been reluctant to move rates down.
Okay. Against that background on short-term interest rates and central bankers, how do you play or how do you invest in the bond market right now?
Well, we don't speculate in the short term. That's just not something that we do. We always take a long term view, and really, we're trying to see where do we see things in 10 years from now. And based on where we are in the interest rate cycle, we're probably still a little above average compared to historical um, rates based on the entire yield curve. So if we think about where things will be in 10 years, they might come down a little bit. They're going to oscillate over time. So there are cycles that are much quicker than 10-year periods, but generally speaking, we're probably a little above where we should be on a long-term basis. So I would say, if anything, we would expect interest rates to come down over the course of the next 10 years, which would mean you would be a little longer duration. That would impact your portfolio in the most favorable way. But we don't see it as a big move. So we're not really changing anything on the fixed income side of things at the moment.
Okay. Yeah, I do not envy your job, James, to be honest, because you have to balance what's going on in stock markets, going on in interest rates, what's going on in bond markets. Have you changed your portfolio approach lately?
We have not changed our portfolio approach whatsoever. We've had the same long-term outlook, constructing based on evidence-based principles that are well documented to work in your portfolios. We do not engage in market timing. We do not flip flop. We do not chase trends or fads that happen in the investment markets. We take a long term view, and those don't change very frequently. But I mean, we are at a pretty important point in time. We have roughly, it's over 80 now. I don't know the exact number of portfolios that we offer, but in our 80 portfolios, we have made 3 changes recently. So 3 out of 80 is not a very high proportion. And one of the changes that we've made recently has been contemplated well before Trump was ever elected. So we are not really reacting to what's happening in the markets. The changes that we have made are very subtle, and they're things that we would do over normal courses of business. So yeah, we're not really doing much in the portfolios, and our portfolio approach has not changed whatsoever.
So, what is your recommendation to investor right now? If they've got some new money coming into the marketplace, it's tax season, RSP season, what do you think they should do?
Turn off your TV, turn off your radio, don't read the newspaper, don't go on the internet looking for advice or guidance, because people are only going to be short-term minded, and you're going to get distracted. You're not going to make good long-term decisions if you're caught up in the frenzy around what's going on. So stay focused on the long term. Stay focused on what works, which is patience, understanding your objectives, understanding your comfort with risk, and don't get caught up trying to make a quick buck based on what somebody thinks is going to happen in the next week, the next month, the next year.
All sage advice, James, except the part about the internet, because the podcast has to go out on the internet.
Okay for that then.
Thanks so much, James. Talk again soon.
Okay. Have a happy birthday and a happy St. Patrick's Day, Pat.
Thanks a lot, Pat. Thanks.